What's going on, guys? Hope you're having an absolutely fantastic day. So today I'm going to talk about the few signs that lead me to believe that there is a high chance of recession in the US, or perhaps they are already in a recession, right? So for anybody watching, they might think, oh, you're just now jumping on the recession wagon. You're really late, right? So no, actually, I actually published a video on my thoughts on this topic in like December or January. So pretty much much earlier than all these professional economists were calling for a recession and all right. So I'll link it on the top right if anyone is interested or anyone wants to call me out and say that I'm bullshitting, right? So first things first, I want to start with the Nasdaq, right? And the Nasdaq at some point in this year was down about 30%, right? So a lot of people will say, "Oh, why are you talking about the Nasdaq stock price?" So stock market and real economy is obviously different, right? Yeah, and that is very true. But when it comes to this, I just want to talk about George Soros, right, and this theory that he came out with, right. So it's called the Theory of Reflexivity, right. So Soros calls this the Theory of Reflexivity. It is based on the idea that feedback loops between expectations and economic fundamentals can cause price changes that substantially and persistently deviate from equilibrium prices, right? So while you let me just explain what that mumbo jumbo means, right? So a lot of people think the economy and the stock market is a separate thing, right? Obviously they have some connection, but they are tending to be separate things, right? But you can see as all these tech stocks and all these startups have been battered down, right? Their stock price have been battered down, right? They have been actually laying off people, right? So this is the facts when something that is not supposed to be related suddenly becomes related, right? Because let's say Facebook or Google or whatever, their stock prices have been absolutely destroyed this year, right? So what ends up happening is they have unhappy investors, and the investors will elect the board, right? And the board will elect the upper management, right? So what ends up happening is because they want to satisfy the investors, they want to buff up their numbers, so they have to lay off people, right? Or even if they are not laying off people, then they don't employ as much people. They can't afford to be burning so much, right? And one more thing is also, obviously, if you have a higher share price, you can dilute shareholders at a lower amount for more money, right? So you can get more money, you can hire more, you can do more R&D and things like that, right? So that's point number one. So the stock market declining, leading to reflexivity and leading to all these companies actually making changes in their real business models, right? Just because some prices of their stocks have fallen. So number two is obviously the unemployment rate. And the unemployment rate is sitting at about 3.6%. So what this means is the people that are looking for a job, only 3.6% of them have not found a job, right? And this might be due to skill mismatches and all. So we can never get the unemployment rate to 0% because obviously some jobs require people with different skills and things like that, right? So I just want to talk about low unemployment rates, right? So obviously this is something that economists think is good, right? But we have to remember that when it comes to economics, right, it's always a cycle, right? Up and down, right? So if you think that when it has reached the down point is the best part, right? Actually, that is a calm before the storm, right? Because if everyone that is looking for a job has found their job, then what do you think will happen after that? Because obviously some companies will have mismanagement in skills and all, and when stock prices are falling, some companies might need to cut jobs to conserve their profit margins and all of those things, right? So you have to think about that as well, right? So it seems that we have reached the lower extreme of the mean reversion curve, right? So at this point, when we have very, very low unemployment rates, so there seems to be only one way it can move, right? It can either move from the bottom and then it starts going up, or more people join into the labor force and then there's more hiring and then there's more jobs created, right? So that is also a possibility. Of course, I'm not saying that just because the unemployment rate is very low means, you know, people are going to get fired or things like that, right? So the third one is also to do with employment, and this is basically a specific one, right? So Amazon has too many workers, an unusual problem for the United States' second largest private employer, right? The company said on its quarterly earnings call last week that it had hired too quickly in its warehouses during the pandemic to keep up with demand for hand sanitizer and masks, as well as cover up workers who caught the Omicron variant. The pandemic sales boom is waning as people want to leave their houses and more businesses open up, right? So you can see always during the boom part of the cycle, these companies tend to overhire, right? And of course, because as humans, we like to project linearly, right? And it's of course very hard to project like, oh, how many workers will get this disease, or how many workers will we need when we are growing like 100% a year or something like that. So you might think, oh, we need to double, and then if there's a tightness in the labor market like we have now, then you might think, oh, I better get these workers, because in a 6 months maybe I cannot get these workers because they are hired somewhere else or something like that, right? But when we reach the upper end of the cycle, of course we have to mean revert, and when we are mean reverting, so obviously they need to start laying off people and all that as well, right? So we're just gonna quickly go through like the tech layoffs, right? So notable 2022 US tech layoffs, right? So these are probably jobs that are paying like maybe 6 figures or more, right? Because they are very high skill jobs, right? So PayPal, you can see 83. So Klarna, which is the buy now pay later company, about 10% of their workforce, 650. So Skills 70. Then you can see 97. Netflix 150. Piscard 90. And here we can also talk about reflexivity, right? Because Netflix, their share price was running, investors were pricing in optimism, so maybe it got to the management's head that this was maybe the way that they were moving forward as well, right? But we can see in this past few quarters, Netflix has actually been really destroyed, right? Because their projections didn't meet up. Their results didn't really meet up with their projections. Right? So you can take a look. You can pause the video if you want to take a look slowly. That's more than I can read out, right? Carvana 2,500. So there's a lot of high skill jobs that are being lost here, right? And if you see that there's a lot of high skill jobs being lost here, what do you think happens to the low skilled labor that are like the retail stores and all of this, right? Because maybe during the boom phase, there's a lot of business and there's a lot of stimulus checks to be spent. So everyone's buying a new TV, new washing machine. So you need those people there. Right? So what happens when it mean reverts and it goes the other way? Right? So you can see that obviously these jobs each, let's say $100,000. And what will end up happening is obviously when you're fired today, you still have all your expenses, right? So if you still have all your expenses, you will continue to pay them out of savings and out of credit cards, right? Which I will also talk about a bit further in the video as well, right? If you are enjoying the video so far and all the information that I'm sharing with you, do help me smash up the like button, hit subscribe, and also hit the bell button, right? It really helps the channel to grow and incentivizes me to make more video and give more coverage towards all these things that maybe mainstream media isn't really talking about. So Bolt, this is another startup company, is firing around 33% of their workforce, right? So 250 employees, and they just raised at an $11 billion valuation, right? So we can see this, even the startups that are growing really aggressively, hiring the top talent, will also lay off their talent, even though they just raised money, right? And this is like a very scary thing, right? Because if these companies which have very big total addressable markets, and they are still currently very small, but they're still conserving cash, right? Instead of aggressively growing, right? That means that all the bigger companies that already have the market share will also require less people to, first of all, defend their market share. And second of all, they'll hire less, right? Because they already have all the profits. And all these startups are the ones that are going to be hit the worst, right? Because all the venture capital money will also dry up. All this heavy risk taking will dry up. And essentially, some of these companies might go bust and might be laying off all their workers, right? So finding a tech job may soon be more difficult as Silicon Valley embraces hiring freezes and a do more with less mantra, right? So this is what I'm talking about. The big firms will just try to maybe have one worker do 1.5 worker kind of job, right? During the boom phase, obviously, everyone thinks they need more and more workers. So to solve all their issues, maybe you have like a issue that can be solved with just one worker, but you hire two so it can be solved faster or something like that, right? So now we take a look at Facebook. So after the stock is down 43% this year, right? So they have reported no plans for layoffs, right? And this is where I want to talk about the good side of this, like having recessions and all of that, right? So everyone thinks that a recession is bad. Obviously, a lot of people will lose their jobs and all of that, right? but it also roots out all the zombie companies and all the companies which are actually not so strong, don't have a real business model, let's say, and it leads all these big companies. If you're invested in them, then you should actually be quite happy, right? Because you know this company, first of all, is not going bust, and this company will become stronger through the recession, right? Because all the weak competition, all the inefficient players will be washed out of the market, and also all the top talent, right? That these maybe weaker companies that maybe were startups or didn't have real business models, when they lay off all this top talent, Facebook and Google and Amazon and all this, they will be there to basically hire all this top talent, and also at a lower cost, right? Because I think last year or 2 years ago, the job market in the US was really, really crazy, up to the point where people were getting like signing bonus just for working in McDonald's or something like that, right? So you can only imagine Facebook, Google, Amazon, all these companies will also be giving like 6 or up to maybe high 6-figure salary just as a starting point or something like that, right? So instead of having high 6-figure salaries, maybe now you have low 6-figure salaries. Maybe instead of having 300,000, now you have 150,000 or 200,000 salary, right? So a lot of people might be like, oh, but that's bad for the workers, right? But this is just a cycle of life, right? I'm not here to talk about ethics or whatever it is, right? Or like corporate responsibility to their workers or things like that. I think you get what I'm trying to say. But I'm trying to say like these are the facts that are happening, right? Sometimes that the companies have negotiating power, and sometimes the worker has negotiating power, right? And for the past maybe couple of years, the workers basically had a lot of negotiating power. But we can see that now when the jobs are drying up, obviously the companies have more negotiating power, right? So another thing I really wanted to talk about is actually Mastercard, right? So this is the four things, the fourth sign, right? So Mastercard basically came out with their earnings a month ago, right? So I couldn't really find the earnings transcript. So I'm not going to go through a lot of the earnings call things again, right? Because I've already went through it one time, right? More specifically, I watched Meet Kevin's video and he really went through it really quickly, right? So why do we want to pay attention to Visa and Mastercard, right? Because these are basically the payment infrastructure and the backbone of the consumer economy, right? Basically, and what was in Visa and Mastercard's earnings was actually, some people might have thought it was really good, right? But actually, what happened was that all the debit card spending is going down while the credit card spending is going up. So what that tells you is actually consumers are going more into debt to continue to finance their lifestyle, right? So I really want to draw something for people to understand like what I'm talking about better, right? So maybe we can see like this is the US economy is going up. Okay, maybe not so fast. And then COVID comes and then it spikes down, right? So then the stimulus, boom, whatever. So it's going up now, right? So up to some point, right? This is organic spending, right? Because you have your stimulus and all, right? But up to a certain point, even though it's continued to go up, right? This is inorganic spending, right? Which is basically people are spending more than they make, right? And this is maybe where the credit cards and all their credit facility comes in, right? And then suddenly you can see that maybe at this point, they will stumble a bit, and then people will be a bit worried, but not so worried, right? Because people are still spending, right? And this is when the consumer has reached basically their max credit limit, right? And then it'll just be like an escalator down, right? And why this happens is because nobody defaults before they need to default, right? So basically, if you get laid off of your job, right, you still have this runway, right? Because you were spending organically, and let me just draw another arrow here. Maybe my cursor is very hard to see. So, and then after that, you still have more runway because you have your credit facilities, you have your savings. But obviously, at this point, let's say you have 100,000 in savings, you're drawing down your savings, maybe 8,000 a month or 5,000 a month, right? So you're drawing it down. And after that, you're using credit, you're using savings. And then after that, it starts to become more wobbly, right? Because you maybe don't have so much credit facilities, or you're struggling to use loans to pay back other loans or things like that, right? And then suddenly, this is a point where you can actually no longer afford to pay all these loans and all these things that are burdening you, right? So this is where the wave of bankruptcies and wave of defaults, restructurings, everything will come in, right? And obviously, you can see that the line always goes up, right? So you can see, if I draw a baseline here, obviously it doesn't go back to the bottom part, right? Maybe this is like the real growth line, right? So obviously you can see that the economy, yes, is always growing, but sometimes the economy gets ahead of itself, right? Because people spend on credit, because let's say you got a new job for 200,000 US dollars or something. So people might spend 220,000 in that year, and they think it's no big deal because next year I'll just get a raise for until 210,000. So I will just come back maybe 10,000 of spending next year. But what ends up happening is they lose their jobs before the next year comes, right? And when they lose their job, obviously they will still have their savings if they are responsible or whatever, and they'll still have their credit lines, right? Because maybe you still have your credit cards or whatever it is, right? But of course, you can see this will eventually end up happening with every credit system, right? So I'm not saying whether it's good or bad. It just happens. So yeah, that's about maybe a brief overview of like what I think is happening in the economy right now, right? So if anyone is wondering like where do I think we are in the economy right now, I'll just put this in red. I think we're somewhere here, right? Where a lot of people, or maybe even somewhere here, right? A lot of people are getting laid off. And a lot of people are starting to need to dig into their savings or dig into credit facilities to maintain their lifestyle while maybe they try to find another job, right? The issue is if they can't find another job during basically this runway that they've got here, then it will lead into some big problems, right? So now the last thing that I really want to talk about is US economy, right? So US economy shrank by 1.5% in Q1, but consumers kept spending, government report. See, obviously a lot of these government reports, right? They obviously cannot factor a lot of these credit things in, right? I'm sure they have a lot of smart people at the Fed and things like that as well. But these things might be missed sometimes, right? Because you see, a lot of people looked at the Mastercard and Visa earnings report and thought it's a good thing because consumer is still strong, consumer is still spending, right? But what ends up happening is obviously, again, this part. And the US economy shrinking by 1.5% is obviously an annualized figure, right? So it actually shrunk like 0 point something percent, right? So if the next quarter there's a negative GDP report print, and then it will officially be a recession, right? So there's like those recession markers. So that will be like maybe a official recession, right? So do I think next quarter GDP report is gonna come out negative? So obviously I'm not Oracle. Even if you ask Warren Buffett, he probably doesn't know, right? But it seems that this US economy shrinking was because the Q1 of 2021 was very, very strong, right? But in my opinion, these things lead me to believe that there is a very high probability of a US recession within the next maybe 1 year or early 2023 at most, right? So if it doesn't come in that time, then I guess you could say, oh, this guy is wrong or whatever. But we always need to take a look at this science and game up some possible scenarios, right? So for me, I think within the next 1 year, it's a very, very high likelihood. I will place it like 60%, maybe even 70%, that the US will go into a recession, right? So yeah, that's about all I wanted to share today. If you did enjoy the video, do help me smash up the like button, hit subscribe, and also hit the bell button. With that being said, have a fantastic day ahead and peace out.